Meet George Soros. With a net worth of over $8 billion, George is both a notable philanthropist, author, and an angel investor. If you'd never heard of George, nor his exploits, here is a man who infamously brought down the Bank of England in a single bet against the British economy. If you can't imagine how one man managed to bring down the Bank of England, the UK's most powerful financial HQ and central bank, stay tuned. Stay tuned to find out how George, a former railway employee, managed to pull off one of the biggest heists in England's history. And finally, stay tuned to discover how he got away with it. The Exchange Rate Mechanism, or ERM for short, is a coalition agreement comprising a list of rules. This agreement was collectively subscribed to by a select group of European central banks. You can think of this gathering of central banks as a syndicate. Formed in 1979, each central bank from this syndicate protects one another's economy. This protection includes ensuring that each currency within the syndicate maintains a stable price that doesn't move above 6% in either direction. This is why in October 1990, the then British Chancellor John Major decided to enter the pound sterling into the ERM. If you live in America, a British Chancellor performs similar tasks to the US Treasury Secretary. Now you know what a British Chancellor does. Back to the syndicate. The syndicate was supposed to protect the value of its currencies from falling. It was this same syndicate that was meant to protect the price of the sterling to ensure that the sterling remained stable. It was the British Chancellor's idea not just to protect the value of the sterling, but also to signal an entry point to a continental unified economy. By joining the syndicate, each representing country's industrial resources would also form this alliance. This powerful alliance included industrial giants like Germany and France. You see, by forming this powerhouse, enemies of Western Europe would think twice about waging war on the syndicate. The theory ran that the syndicate would effectively form a united front, warding off any possible future attacks. So far, so good. Well, there's a catch. The catch was the syndicate's protection was not guaranteed. Over several months during 1992, George built up a huge short position on the pound sterling. All in all, the size of his bet amounted to a $10 billion short. From the beginning of 1992, George figured that the value of the sterling would fall dramatically against the Deutschmark. You see, in George's eyes, the dramatic devaluing of the sterling was based on what he saw as a currency whose value was unsustainable. Before the 1990s, the pound sterling mirrored the German Deutschmark in value. During this era, and mirroring Germany, the UK offered low interest rates. Low interest rates enabled business owners to borrow money cheaply. At the same time, the same low interest rates meant that the British public could also borrow money cheaply. This is why, with a liquid marketplace, the outlook for the UK seemed bright, or at least it seemed so on the surface. However, unlike the German economy, the UK suffered from a higher rate of inflation. Thus, the cost of living for the average citizen steadily rose. In contrast, Germany enjoyed lower inflation, meaning that their citizens saw fewer rises in their cost of living. It was this marked difference that George observed. You see, George knew that comparing the UK economy with Germany was a short-sighted mistake. He knew that the wheels of the UK economy were about to fall off. As George's Big Short began on Wednesday, September 16, 1992, the British government panicked. With the full weight of the new Chancellor, Norman Lamont, the Bank of England galvanised its resources to defend the sterling. While George was selling the sterling in the billions, the Bank of England was buying back the sterling in quick succession. Like a tug of war, the pound sterling's value swung left and right. In a single day, the UK interest rate rose from 10% on market open to 12% before shockingly rising to a stress-inducing 15% at market close. Unbelievably, this unforeseen drama in the markets all took place in one single day. By market close that Wednesday, the Bank of England, in a desperate bid to save the sterling, had sold off its foreign currency reserves. You see, for the Bank of England, it was an act of pure panic. At the time, the losses were estimated at a conservative $2 billion. Yes, believe it or not, a $2 billion deficit was reported at the time as a conservative loss. George's Big Short was a humiliation for John Major, the now former Chancellor. The day of George's Big Short will forever be known as Black Wednesday. Ironically though, for the Bank of England, their balance sheet was anything but in the black. As for the true losses suffered by the Bank of England would be hidden away in a vault for 13 years. Finally, in 2005, the UK Treasury released a dossier revealing the full extent of Black Wednesday. As it turned out, the loss on Black Wednesday wasn't $2 billion. No, you're not even close. All in all, on Wednesday, September 16th, 1992, a staggering $40 billion was spent by the Bank of England trying to buy back the sterling that George had shorted on his $10 billion bet. So you ask, why were the UK interest rates so high at the time? High enough that a hedge fund manager like George Soros could exploit this weakness for his own financial gain. Well, remember how the Syndicate was meant to protect its members? Here's the catch. The Syndicate's protection was based on each member being compliant. This level of compliance meant that in order for the UK to stop the price of the sterling from moving above or below 6%, it had to raise its interest rates to attract new buyers. In theory, this practice by the UK government was promising. Raising interest rates to protect the value of the sterling attracted new investors that could lend out the sterling at a higher rate. However, interest rate hikes proved bad for the British public. If you were to compound that with high inflation, it was a recipe for disaster. As for George, through his hedge fund operation, aptly named the Quantum Fund, he acquired two things. First, $10 billion from his bet that the sterling would fall below the Deutschmark, and his second acquisition was notoriety. Now referred to as the bogeyman, in the eyes of the British public and press, George represented the embodiment of capitalist greed. In the aftermath of Black Wednesday, the British Chancellor, Norman Lamont, was forced to withdraw the sterling from the ERM. Now out in the cold, the UK government faced a huge backlash from both the press and the UK public. For a guy like George, Black Wednesday was business as usual. So how did George see the writing on the wall when his competitors didn't? George's childhood was spent in Hungary. Hailing from a prominent family in Budapest, George's childhood was spent concealing his Jewish heritage from the then Nazi-occupied Hungary. You see, at the time, concealing his heritage was an act of survival for both George and his family. During his late teens, George moved to London, where he took on part-time employment to fund his studies. After graduating from the London School of Economics, George worked at a merchant bank in London before finally moving to New York in 1956. Unlike his competitors, on Black Wednesday, George understood the theory of reflexivity. You can think of reflexivity as cause and effect. For example, when action ABC happens, this action has a knock-on effect on future events. Future events, in turn, are partly dependent on the original ABC action. So, in the case of the pound sterling, high inflation versus a stable economy equaled impending doom for the economy. The effect of the UK's attempts to stabilise the sterling proved difficult to sustain. You see, George saw this weakness, a weakness that so-called financial experts like the British Chancellor had overlooked. Under mounting pressure from the agreement set out by the Syndicate, the British Chancellor had no choice but to raise interest rates. he had to raise interest rates to protect the sterling so that it continued to shadow the Deutschmark. You see, George's understanding of the reflexivity theory resulted in a golden opportunity for him at the expense of the Bank of England. Today, from his New York office, George's quantum fund continues to make further shorts on central banks. However, none of these shorts have gained as much notoriety as George's big short against the Bank of England. If you liked this video and would like to see more videos like this, click the subscribe button to support my channel. Until the next time, thanks for watching.